So the main event, we're here really to listen to Mary talk. She brings a wealth of experience around life insurance and specifically how it applies to us as investors. I think a lot of times this is something that, me personally, this is something that gets left to the side, right? We don't plan for it properly, and then when something happens, like we get sick, we don't have the ability to cover ourselves. Insurance is what we think about after there's a problem, never before, and when things are going well. And for me personally, this is something that this year that I said I really have to get behind, and Mary was actually the one to help me through this process. She's going to talk about things that are a little more advanced as well, not just the kind of stuff that you might know, like term insurance, life insurance, things like that, but how we can use insurance as part of an investment product to help fund our real estate deals. So things that are maybe you haven't heard of before, but a little more advanced look at it. I personally use Mary to help me out with my insurance needs. And if you have any questions about her, you can contact me. I'll also invite Mary to leave her contact information in the chat group, and I'm sure she has it in her slides if anybody has questions. So without further ado, then I'll hand it over to Mary. Matt, if you can cue it up for her, I'll do that.
Does that mean let her
share her screen? And Mary, I think you are logged in.
Yeah, she's right here. I just don't know how to let her share her screens.
I think we have to allow everybody to share their screens and then turn that.
How do I do that?
Mary, are you there?
Yes.
Great. Can you share your screen?
Oh, no. Okay. I just gave her the option now. Okay. So Mary, click on share screen. There you go. Good job.
Awesome. Cool. So I'm going to drop off here, guys. I'll leave my contact information in the chat group, but thanks everyone. Have a great night.
Thanks, dude.
See you guys.
Okay, go ahead, Mary. The floor is yours.
Yeah, good evening, everyone. Thank you for inviting me to this session. I already feel the dynamic and the momentum of this group, and thank you, Matt and Ming, for the market update. I did learn a lot about the team, and I hear you use the term value added and differentiate a lot. That are the value proposition that I resonate. So today I want to take the next about 15 minutes to share my insights about life insurance. Hopefully you will pick up a point or two and apply to your real life financial planning, and that will make your investment journey even more successful. First, as usual, is the disclaimer. This presentation is prepared for information purpose, and any examples are for illustration purpose only. The opinion and analysis do not constitute advice in the areas of legal, accounting, or tax. It is recommended that you consult with the appropriate professionals in these areas. So here is a quick introduction of myself. I'm a chartered professional accountant. I have my MBA degree from Schulich School of Business, more than 10 years of experience in financial service industry in Canada. I work for RBC in serious senior analyst, manager, and senior manager roles. I'm a Sun Life advisor with a mutual fund license and life insurance license. I put my contact information here because I have fully loaded content today. If you have any question, you can put your question in the chat box. I hope I will have time in the end to address your questions, and my contact information is here. If you have any question later on or need any additional information, this is the time that you can take a screenshot with all my information and reach out to me later. I will be very happy to address your questions and provide my value-added advice. So here is the agenda today. start with estate planning case, insurance for family protection, life insurance introduction. Then I will focus on participating whole life insurance. This is a superior product that is very attractive to high net worth clients and real estate investors. I want to say that these products bears a lot of similarity of the real estate investment and has been used by so many high net worth family and real estate investor to use as a tool to protect their asset and build their wealth. Next, I also cover liability, exposure cycle, and estate building cycle from a real estate investor's point of view. Also, there will be introduction of the Sun Life proprietary analytical approach to identify clients' needs and drive recommendations, which have been proved very value added to the financial advice journey that we provide to the clients. Also, I will cover the life insurance ownership at the end. The last will be the Q&A session. And today I have two of my Sun Life colleagues. They are in the audience. The first one is Ted Girard. Ted is the District Director of North York District. And also Eddie Tong. Eddie Tong is the Business Development Manager of North York District as well. They will join me in the Q&A session. So first of all, I want to start with a case study. This is a real estate planning case. When I do the financial planning for my client, I always believe we begin with the end in mind. So what are the considerations that a real estate investor, quote unquote, in people's eyes, the rich dad or rich mom need to consider when they plan to pass on their property to next generation, and then when they start to working on their estate planning. So here is the case. So Mr. Johnson passed away early 2020. His wife passed away 2 years before. Under Mr. Johnson's will, his daughter Wendy is designated as the beneficiary of Mr. Johnson's 4 rental properties. The average adjusted cost base of each rental property is $400K each. The fair market value at the date of Mr. Johnson's death is $750K each. There is no outstanding mortgage balances for all of the 4 rental properties. What steps need to happen before the 4 properties can be successfully released from Mr. Johnson's estate and transferred to Wendy? Does the audience have any answer to this question? If you do, please unmute yourself and then shout out your answer.
John, unmute yourself.
Hi, probate.
Excellent. Anyone else?
I think it's a 3% probate charge that one has to consider.
Yeah, excellent. So I know, like for estate planning and asset transfer, it is a very lengthy and complicated process. But like to summarize, right? Basically, there are 2 items you need to put on your priority list and make sure the inheritance happens smoothly. So I will unfold the 2 secrets here. So for this, you just need to remember there are 2 certificates that will be required. The first one is from CRA. So for the person passed away, they have to file their final tax return. In Canada, there is no inheritance tax in Canada, but there is the deemed disposal of any capital property. So once the final return is filed, the CRA will issue the tax clearance certificate. So that one executor can apply using Form TX-19. And the second certificate is called estate certificate. So this year they have a new name for it, but basically for real estate asset, it needs to go through the probate process to make sure the will is the updated will, is valid updated will, and then to certify that this executor is the legitimate person to administer the estate. And also effective January 1st, 2020, Ontario Estate Administration Tax, we also call that EAT tax. The other name is probate fees. 1.5% will be charged on any estate amount that is greater than 50,000. Once the probate process is completed, then the Ontario Superior Court of Justice will issue the certificate of appointment of estate trustee with a will. The other name is called estate certificate. So you just need to have to remember 2 certificates that is required. So to get this 2 certificates, there are costs involved for sure. For final tax return, for this 4 rental properties, capital gain in total is 1.4 million. Ignore other incomes, right? The income tax payable is about 336K. So for the probate process, based on the formula that I mentioned before, for the full market value of these 4 properties minus the 50K in exempt amount and times 1.4, the probate fee come up to be around 44K. So ignore any other legal and accounting advice that will cost extra. The total funding required to get those 4 property released and change title to the next generation, to the daughter of Wendy, the funding required is about 380K. That means money. It can be costly and it can cause estate shrinkage. And for a lot of high net worth client and real estate investment client that I have, they use life insurance, use the tax-free death beneficiary to pay. So the beneficiary usually work with the executor to coordinate, get the final tax filed, and kick off the probate process, get the 2 certificates, and get the properties transferred to the next generation as soon as possible without liquidating any other assets from the people passed away. So then let's see, right? For the final tax, are everything taxable? Is there anything that is tax-free or can be tax-free, tax-deferred that we can properly prepare to take advantage of those items to minimize the estate shrinkage? So for taxable item, right? For the year that the people passed away, they need to file the final tax. Final tax include income earned from all sources for that year, like the ordinary personal tax return, but it will include income from deemed disposition of assets, such as real estate, like your cottage, your rental property, and the full value of your RSP or RRF, and your investment in non-registered accounts. And there are items that are tax-free. So this section, you just need to pay attention to make sure we planned properly, right? So the first item is the death benefits of a life insurance policy, your principal residence, capital gains exemption. So always remember to designate one of your properties as your principal residence. And for RSPs or RIF, that is rollover to the spouse of the deceased, TFSA is always tax-free. And for the estate probate process, what are included and what are excluded, that means it can bypass the probate process. What are included, for sure, first item on top of the list is the real estate in Ontario. It's the fair market value less liabilities. For the real estate outside of Ontario, it doesn't go through the Ontario probate process, but it should go through the probate process, well, local probate process. Your bank account, your investments, your registered account without a designated beneficiary, and your vehicles, the vessels, or other properties. The excluded items are the ones that we need to pay close attention to. Joint owned assets with a right of survivorship, investment with a designated beneficiary. So for, and next one will be insurance that will be paid to a named beneficiary. The insurance here includes life insurance, includes critical illness with the return of premium on death option. So when I do the annual return with my clients, right, I do find some of them, they got a policy years ago from any insurance company. Sometimes they forgot to assign the named beneficiary. They use the estate as the beneficiary. In that case, if you use estate as the beneficiary in your insurance policy, that policy will not be exempt from the bypass process, and it has to go through the probate. But for the insurance, use the named beneficiary will bypass the probate process. And the next item will be the assets in a trust created during your lifetime. Your CPP death benefit will bypass probate. So if you compare those two lists, right, you see real estate, life insurance showed up on both lists, and real estate is taxable, is included in estate probate, and then life insurance with named beneficiary is tax-free, tax-deferred, and will bypass probate. That means these two items can walk hand in hand when you do your estate planning. Then you will ask, right, what for family protection? There are so many different insurance products. Like what the landscape of the insurance product. To summarize, basically there are 4 types of insurance for family protection. There is the life insurance. Life insurance is the insurance that is the lump sum payout upon death, but there are many other tax-efficient usages that I will unfold in the rest of my presentation. There is the critical illness insurance. Critical illness insurance is kind of a living benefit. That is, you will benefit from it when you are alive. So it is a payout in the event of critical illness covered by the policy. Disability insurance provide income to sustain if you sustain a serious illness or injury. Long-term care insurance helps to pay for care services that government program don't provide. And there is the personal family health plan. Is that drug, dental, paramedical coverage complementing OHIP coverage. So that is the landscape of insurance for family. Then you are very interested in finding out more about life insurance. So for life insurance, for me, when I meet with my client, right, I use two dimensions, two categorizations to help them to understand it. In regarding protection duration, you can divide it, all the life insurance, into two categories. One is term insurance. So it's like term 10, term 20, term 30. Just bear in mind, right, the term insurance coverage ends at a certain age. You cannot renew it forever. So for Sun Life's term insurance, it has the longest coverage duration. It will end at age 85. And when they for whole life, that means if you will have the protection for the duration of your lifetime. Let me give you an example here, right? David, age 35, term 10. David is a non-smoker, healthy, just standard rating, a coverage of 1 million. For term 10, if you look at the monthly premium, right? For the first 10 year, it's 45. Next will be 137. You can see, right, at the renewal time, the monthly premium will increase dramatically. So from age 36 to age 85, if you do the math, you do the calculation, the total premium is about 640K. And for that 640K, right? So if nothing happened and David didn't convert it into permanent life insurance during that period, that 640K at age 85 will be lost permanently and will never come back to the economic life of David and contribute to David's wealth growth anymore. And the family, right, end up without coverage after age 85. So this is what we don't want it to happen. But for term insurance, from age 36 to age 45, the monthly premium at David's age is only $45 per month. It is a cost-efficient solution to cover that period of time and to mitigate risk for the family. So the next categorization I use is participating or non-participating. So to remember how to differentiate participating and non-participating. So one thing, or maybe you just remember, right? It depends on if you receive dividend from the insurance company. I will explain how does the participating account work in my next slides. So for non-participating, right? So all the term insurance is one dimension, it's only for protection, so there is no dividend payout. Permanent life insurance cover the whole lifetime protection, one dimension, no dividends. Universal life insurance covers whole lifetime protection. There is the investment portion of universal life, but that investment need to be managed by the policy owner, him or herself, and that policy owner doesn't receive dividend from the insurance company. Then it's the participating. We always call that participating whole life. It's lifetime protection and receive dividend from the insurance company. This participating whole life insurance is most popular among high net worth client and real estate investor because it is multi-dimension and can be used in a lot of different ways to save your tax, protect your asset, and grow your wealth, and help you with your wealth transfer. So this is how does a participating account works. Basically, all the policy owners they pool their premiums together, and after deduct the insurance expense and operating expense, and whatever left over, the insurance company, if you use Sun Life's participating account, Sun Life participating whole life, it will be managed by the Sun Life participating account investment management team to manage the investment, right? All the management return will be calculated, offset the expense. The surplus depends on the board of directors' decision every year, will be issued as dividend to the policyholder to return back to the participating policyholders. So here is another case, right? So David David is very busy today. We use him several times in our case. So David is age 35, non-smoker, is very healthy. The insurance policy we choose for him is participating SunPar Protector. The guaranteed monthly premium is $620. The coverage start with is $250,000. The dividend option here is called paid up addition. I will give you more details about that option. Your premium option is 20 pay. 20 pay means that your policy will be paid up in 20 years. Now let's look at this table, right? So David is 35. I listed the performance of the policy by 10 years interval. It's age 40, 50 until age 100. There are 6 columns, right? So we start with the guaranteed cash and guaranteed insurance amount. Because David start the coverage with 250, that is the base protection base of the policy, and it has, for participating whole life, there is a guaranteed corresponding cash value with that base protection. It is always there, it is guaranteed, and the cash value increase. Then there is, because it's a participating whole life, right? They will receive annual dividend. If you look at column 3, annual dividend will be paid to David. And for annual dividend, there are 5 different ways to be used. But just give you the answer. For the 5 dividend options, 90% of the time, the whole life policy owner will choose paid up additional insurance. Why? Because so this annual dividend, right? So you use that to buy more additional insurance. If you look at age 40, the annual dividend of 1,108 will be used to buy additional insurance of 13,658. So by doing that, right, your total death benefit you will increase from the basic 250 to 263 and $158. It increased dramatically. The beauty about this option is, and why people go for that option, is because so you get the death benefits increase over your lifetime, but you don't need to provide additional medical evidence. Because when you go through the original underwriting process, all those possibilities have been already considered. If you are approved, you offered that benefit for your lifetime. So here, annual dividend with the cumulative annual dividend, your total cash value grow over your lifetime, and your total benefit, death benefit, will grow over your lifetime as well. So for David, right, start contributing from age 35. For, if you look at here, for the total cash value, it will grow to $1.8 1 million at age 90 and to 1.7 million at age 100. The death benefit continues to grow. Then what does that mean, right? That means with the paid up additional insurance, you will enjoy the growth of the total cash value and total death benefit. Then this is the picture, right? So it's a little bit busy slide, but just pay detailed attention to it, because this page shows all the merits of the participating whole life insurance. As I mentioned before, if you look at here, the annual dividend grow over time, and the current dividend scale, that is the dividend payout rate, is 6.25% for Sun Life's participating product. So this one, the 25-year average is 7.54%. The beauty of this annual dividend is because of the insurance legislation, this dividend cannot be zero or less. That means compared to any other investment, this one has the growth over time, and there is no volatility as any other investment products in the market. And for the total cash value, right, it grows over time. Just a recap a little bit, right? If you look at the left-hand side and just, so David, from the previous slide, David pay a monthly premium about 620, and this policy will be paid up in year 20. That means when David is at age 55. If you do the math, the total calculation of the premium is 149K. Like if you look at the total cash value, say at age 90, this total cash value grows to 1.1 million. And the total death benefit grows into 1.3 million. What did David do? David didn't do anything other than pay the premium on time. And after 20 years, like he doesn't need to care about the insurance. Leave it for the life insurance company, leave it for Sun Life to manage it. Then all of a sudden, he realized there is a house building up in his property because the cash value is growing silently and the death benefit is growing silently. So did I do the math right? So with a 148K cash outflow and the cash value and death benefit grow more than 1 million over years. What's the magic there? The magic there, let me tell you. First of all, the driver is from the annual dividend. It is paid out at a dividend scale of average 7.54 over years. And the other beauty about the policy is for participating whole life insurance, it enjoys the it's called a tax-exempt policy, because for all those dividends over year, as long as they stay in the policy, you don't need to pay tax. If you don't need to pay tax, you then with the compounding growth within the policy, this growth can be significant and it can be phenomenal. So with the continual growth of the dividend, accumulating the cash growth, value growth over time. And it is a house, right? So it bears the similarity of the house. For the house, you pay the down payment, you pay your mortgage, then there is the cash value, the equity built up in that asset. That's why participating whole life insurance is considered a separate asset class. It can work hand in hand with your real estate investment and any other investment as a separate asset class. Since there is the cash value, there is the equity value of this policy, so you have the flexibility to access the cash value, and there is the collateral value of the cash benefit value of the policy as well. That means you can leverage it, right? So I will explain how it can be done, right? To access cash, there are basically 4 main ways. You can use the policy loan, you can do direct withdrawal, automatic premium loan, or collateral loan. And for death benefit, right? The other beauty about this policy is when they pass to your next generation, it's tax-free. If there is a named beneficiary, it can also bypass probate. You don't need to pay the probate fee, and the property can be released fast, quickly to the beneficiary. It's a protection of your privacy as well, because if it go through the probate process, you will become public information and your privacy is not protected. It's an asset protection because it is raw within the policy, tax exempt, and also tax-free to your next generation. That means it will help to protect and grow your estate value. There are 4 main ways to access cash value: dividend cash payment, cash withdrawal, policy loan, and a collateral loan. So when it comes to the loan, right, there is always the collateral portion, the leverage, to use the capital. You can use it several times, right, to contribute to your wealth growth, right? So for policy loan, it is done within the policy itself, so it will be addressed and processed by Sun Life, and it's a very quick and convenient process. And for collateral loan, with any financial institution and with Sun Life's credibility and reputation, so your policy is a solid collateral, has solid collateral value. So this is a typical letter we issue the client. If the client used the participating whole life policy and leverage the cash value to get the policy loan. So this is one of the client's letter. It happens in July this year. So the client used that policy loan as the down payment to purchase his next property. So Sun Life will say, we have processed your request and deposit $220,000 to the bank account you authorized. The loan interest rate is 4.45%. So the 4.45% is current policy loan rate is prime plus 2, and could this, because it's variable, right? And it could change at any policy anniversary. If the rate change, you will be notified on your annual policy statement. If you have any question, feel free to reach out to us. So this is a July letter for one of the clients using the debt leverage. And for this is, I just provide you more information, right? Here is the highlights. there are four main ways. There is what type of clients it will be appeals to, and the impact on total cash value, impact on total death benefit, and there is, of course, tax implication. So for policy loan, let's focus on policy loan and collateral loan. So policy loan usually is a temporary need for cash and intends to repay. The beauty of policy loan and any loan, right? It's a loan. It doesn't impact the total cash value, and it doesn't impact the growth of the total death benefit. So for policy loan, if you look at here, right, the total death benefit growth will be intact. What will happen is the loan balance will reduce the proceeds payable at death. So your beneficiary just receive the net remaining balance of the death benefit. And the other beauty about policy loan is the interest can be deductible if it is used for any like profit earning business, right? So for the previous client of that policy loan letter that is addressed to, he used that as the down payment of his next rental property. In that case, that interest will be deductible. And for the year end, Sun Life will issue a tax form T2210 to indicate what is the interest portion that can be deducted for personal tax return purpose. And for collateral loan, right? It will be suitable for clients with liquidity need over an extended period of time. And for the proceeds at death will be paid to lender first, then remainder goes to policy beneficiaries. The borrowed amount received tax-free, interest deductible will, if paid and meet Income Tax Act criteria. Basically, if it is for income generating purpose, it can be deducted. So next, I think for the audience, probably you heard the insurance retirement plan a lot of times, right? So in essence, the insurance retirement plan is a collateral loan. So for David, if he purchase or invest in a participating whole life insurance of Sun Life's Par Protector, he contribute every year about 27,000 over 20 years, and the cash value of that policy will grow over time. Say at age 65, the policy cash value will be about 1.3 million. Say if David want to use this policy as to support or supplement his insurance, his retirement income, he can use that policy to get a collateral loan. For this model, I use 4.45% as well to be conservative. But in reality, nowadays, if it is collateral loan, it's a more favorable rate than the policy loan. So it's lower than 4.45 at this point. But even use 4.45%, and David start withdrawing annual amount of 70K, right? By the age of 85, he has been withdrawn 70K for 20 years. If you look at the loan to policy cash value, it's only about 66%. So for policy, for collateral loan, usually the loan to value can be between the range of 75 to 90%. So David still have a lot of room if he wants to increase the annual withdrawal. And the beauty is this, because it is a loan, right? It doesn't impact, it will not be taxable, and it won't impact David's any other like CPP, OAS, or any other benefits, right? If he is entitled to. And so at age, let's see, age 85, right? If David passed away at age 85, so there is still about 2 million here can be distributed to the beneficiary. So the calculation will be the policy death benefit of 4.3 million here, minus the loan balance, that is the principal plus interest, and net proceeds to pass to the beneficiary is about 2 million, and it can be passed on tax-free. So as I mentioned, right, for all those factors, the most important driving force is the investment return of the participating account. Why we can rely on Sun Life participating account? Sit assured that it will grow over time and provide me and all the policy holders the protection and the death benefit that they can rely on. Now let's see the competitive edges of the Sun Life participating account. So for Sun Life participating account, the top 3 advantages that stands out is if you look at the pie chart, right? So we invest in private fixed income 17%, real estate 13.2%, and we invest in commercial mortgage as well. So for private fixed income, like if you look at the other competitors, they do not use private fixed income to the same extent. So if you know about the Ontario solar farm, it's the amount is about 78 million. And for the commercial, I have project details in next pages, but just put the highlights here, the commercial mortgages and the real estate, right? So for real estate, we invest in high quality building through construction projects and acquisitions of existing real estate. That project attract very attractive return, and it also protect us against inflation. If you look at this, right, for a regular retail investor, we don't have access to those profitable and stable return projects. So by investing in Sun Life participating account, participating whole life insurance, you have access to investments normally only available to institutions and corporations, those institutional investors. And we have a very strong and experienced investment team, have I think around currently more than 200 analysts to work on and look after this participating account. So this is the first competitive edge is like private fixed income over a year. We kind of achieve a return of about 17%. Sun Life par account, participating account is the leading private fixed income investor in Canada. Asset class normally reserved for large lenders, and the bottom is the Ontario solar farm. And next is the Bio-Canada headquarter. It's a part of our portfolio as well. For real estate, right, we access to assets not accessible to the average investor. We hedge it. that real estate investment will hedge against low interest rates and inflation, achieve a return rate of 13.2%. That project generates a very stable income stream and is well diversified geographically. This is managed by the experienced and the real estate team. It's high yields relative to other asset class and can achieve long-term capital. So those are the projects that a regular retail investor don't have access to. But if you are if you are an owner of one of our participating whole life insurance, you become the likely institutional investor. So this is the historical return, right? So this one that is very convincing performance over a year. So for Sun Life Par account, 25 years is 7.54% of return, but we only have a standard deviation of 0.77%. So compared to, it's lower even than 10-year bond, 5-year GIC. And I know we don't have enough time, but I will just go through all my slides quickly, right? So for current dividend scale interest rate, if you compare to Canada Life and Equitable Life, those are the two companies have long history of participating account. That's what we compare to. So Sun Life has the highest dividend scale, 6.25, Canada Life 5.10, Equitable Life 6.2. If you look at deviation, we are less, we have the least volatility. Quickly go through another case, right? You just read through it. I think this one is kind of like typical family. Some of the violation group family will be in this kinds of condition. Say David, still David, our friend David, 35, project manager, Linda, 33, the wife is an engineer. They have 2 kids, Emily and Andrew. They have annual salary, they have RSP, they have TFSA, RESP, and they have 2, 1 principal residence, 2 condo property. So those are the basic information. In Sun Life, as the Sun Life advisor, we do the fact funding with the client. After we capture all those basic financial information of the clients, we leverage a proprietary, a very robust analytic tool. So that tool will factor in your life milestone, your major financial objective, like your retirement, your major purchase, your education, investment, and also like your estate planning. We put everything in that model, and we run it, and we identify how far away are you in getting and reaching your milestone and then achieve your financial security and achieve your financial goal, and what are the risks. So I put all David's information, and they talk to me about their goals, and I leverage the analytical tool. So here is the detailed cash flow projection for a family with property investment like David. Their cash flow picture is like this. Salary play an important role. Rental income plays an important role in total cash inflow, and cash outflow are those real estate related expense. And the other biggest item is federal income tax. Then we will look at the estate analysis. What is the liability? What are the net worth trajectory. What is the additional income tax at each year? So for each year, right? So we just assume this analysis is kind of a snapshot of the family's asset and estate condition. And if both couple pass away in that year, what will be the estate value look like, and what does it mean to their estate planning? Say for David's young family in their 30s, so their liability, right, like change over time. So for current year, is 1.3 million mortgage outstanding, and for in 15 years, that amount becomes smaller, is diminishing, right? Because the assumption here is they don't purchase more properties. But if they decide to purchase more properties, this liability landscape will change, and we need to adjust the financial planning and insurance planning for this family. We do annual review with I do annual review with my client, especially if there is any life event. Say they have newborn, they get married, they move to a new country. So those will change their picture as well. The net worth, right? This family increase. It's a great thing, right? They accumulate net worth over time. But for any year, if anything happened to the couple, their final income tax will grow over time as well. That means they need to pay the final tax and factor in all those factors, right? So there will be estate shrinkage. They are just a beginner of the real estate investor. If the sophisticated investor like you're in the audience, like the estate shrinkage can be higher, because majority of the final tax will be in the highest tax bracket. In Ontario, it's about 53.53 for 2022. So for this family, we have the following recommendations. For liability exposure, we recommend life insurance with coverage matching the liability exposure pattern of the family. And we mean to sustain the family's cash inflow, because it's critical to sustain the family's financial goals, right? So they need to have a disability insurance to replace the income if anything happened, and then one of the couple or they cannot work and then earn the income. And critical illness, health insurance is also in our consideration. Of course, for estate planning, right? The life insurance will, with lifetime protection and increasing death benefit, will be a must for the family with real estate investment, because your estate value will grow over time, and the final tax and estate tax will be higher, assuming you keep all those properties. For the tool that I leverage, right, it gave me the picture of the family. So for this family, sorry, I'm running, I promise I will wrap up in a couple of minutes. So this family, right, there is shortage of the kids' education. So we provide recommendation to for them to achieve their education goal, for increase their saving and then allocate TFSA for their emergency fund, just to satisfy the emergency fund requirement. And the other option for the family, if they want to give their kid a head start, like an alternative option for them will be buying participating whole life insurance for Andrew. Is 2-year-old now. So for annually, right? They only pay the premium for 3,500. It's roughly around 300 per month over 20 years. Sorry, over 20 years. Then they don't need to worry about it. At age 28, Andrew will have total cash of 135,000. And at age 65, Andrew will have 1 million cash value that he can use it for support retirement or leverage in any way he wants. The death benefit at age 65 will be 1.7 million, and it will grow over time. And the initial cash outlay for Andrew's parents over 20 years is only about 70K. So that's the last topic that this group showed a lot of interest will be the life insurance of corporate ownership. The advantage of corporate ownership will be the premium, because corporate has a lot lower tax compared to the personal tax rate for like a small business. With small business deduction, the small business as low as the tax rate is 12.2%. And the beauty of the corporate ownership is the capital dividend account, and also there is the creditor protection. It will protect the cash value from the shareholders' personal creditors, but there is risk associated with this. While the accessing cash value can be costly and increase the taxability on final tax. But you can look at the details. But there is ways with proper tax planning that increase the tax liability can be reduced significantly. That there will be the freeze estate and also the pipeline strategy will come into play. So if you guys are interested, I will prepare and information for you to address your inquiry and question in that topic as well. So here is the financial planning period. So you guys, congratulations are in here. On top of the financial planning period is the real estate investment. You're doing great in your financial planning, but don't forget, right? So this period needs to be built on solid foundation. And those are the insurance solutions that will protect you, your loved one, your family, and your estate from those non-controllable events, and to make sure your family, your loved one, and your estate value is protected. So with that, I will summarize my presentation. I know it's a lot of information. It might be overwhelmed for some of you, but leaving this session, you only need to remember basically 5 numbers: 1, 2, 3, 4, 5, 1 pair. So real estate and insurance always work hand in hand. 2 certificates need before beneficiaries can inherit a property. 3 competitive edges of Sun Life's participating whole life policy, and also the Sun Life's participating account. 4 main ways to access cash in a participating whole life insurance, and 5 types of insurances to help protect income, family, and wealth. Summary: nothing is certain but death and taxes. Get insurance when you are healthy and insurable. Future financial success depends on your financial plan today. Work with a financial advisor. And next step is on your hands. Take action.